If you've invested in this syndicated conservation easement and the IRS is now asking questions, this is not a routine audit. I don't care what anybody tells you. This isn't about paperwork. This isn't simply about whether your deduction survives and whether the case stays civil, because in today's enforcement environment, conservation easement transactions are treated as high risk from the outset by the government. And when the government sees certain patterns, that exposure can expand way beyond simple tax adjustments. We're talking life-altering penalties, disclosure violations, and in extreme cases, criminal tax investigation and prosecution. So why is the IRS treating these as enforcement priorities? Well, for years and years, syndicated conservation easements didn't really attract much IRS scrutiny, but they are now. Why? Because they've been marketed as investments, promising deductions multiple times over of your investment, up to 5 times. When the pitch emphasizes a ratio, 3, 4, or 5 times the cash you contributed, the IRS starts to immediately analyze, does this meet the Internal Revenue Code 170H requirement? Does it qualify as a qualified conservation contribution? Was the valuation realistic, or was it engineered? Congress has narrowed the playing field further through 170.8.7, which generally disallows certain partnership or S-corporation easement deductions that exceed 2.5 times the relevant basis. This means in many syndicated structures, the deduction may be statutorily disallowed from the gate before valuation is even analyzed. Add to that the listed transaction rules that most people are blowing off, your disclosure obligations, and heightened enforcement guidance, and you have a transaction class the IRS is actively targeted. So where does civil risk turn dangerous? Most taxpayers assume this is about appraisal disputes. Well, sometimes it is, but criminal tax exposure will not grow from valuation disagreement alone. It grows when the IRS believes there was intentional inflation, fabricated support, backdated documents, coordinated narratives, or altered records after an audit inquiry begins. What shifts this type of case criminally is not the underlying conservation purpose, it's the credibility of the players involved. Once credibility becomes the issue, your audit stops being technical and starts being interpretive. And interpretation is where criminal tax intent gets inferred, and that's dangerous. So what are the legal pressure points in a syndicated easement audit? The IRS often attacks through multiple channels simultaneously. Statutory disallowance under 178.7, valuation penalties, including a 40% gross valuation misstatement penalty under 6662H, reportable transaction penalties, including 6662A and 670.07A, failure to properly disclose illicit transaction. That can keep the statute limitation open. That means exposure doesn't close when you think it does, and penalties can exceed the original tax benefit multiple times over. If the government frames the case as abusive, they use penalty leverage to pressure resolution. If they see inconsistent narratives, they escalate the case criminally. So what are the high-risk audit patterns the IRS targets here? Well, there's some recurring red flags they're focusing on. If your transaction includes these, expect heightened scrutiny. A marketed deduction multiple, compressed timing from acquisition to donation, aggressive highest and best use assumptions in the valuation, substantiation defects, especially Form 8283 and appraisal issue, post-audit document revisions or new explanations. One of the most dangerous mistakes taxpayers can make is attempting to clean up the file after receiving an audit notice. They put in revised documents, new memos, or they start punching in standardized talking points from some crazy representative. Those often create more damage than the original return, because now the IRS isn't reviewing your deduction anymore, they're reviewing your conduct. So how does a firm like mine go about controlling the audit without creating criminal tax exposure? Whoever you hire must manage parallel civil and criminal tax exposure. That means centralized communication, controlled document production, and most importantly, no improvisational narratives, no contacting promoters for clarification, no revised justification. If disclosure rules are at issue, Form 8886 compliance must be analyzed immediately. If statute issues are present, your representative must understand what remains open, and every written submission must be drafted as if it would be reviewed by the IRS Criminal Investigation Division. Why? Because sometimes it will. Better safe than sorry. Strategy matters here. If you claimed a conservation easement deduction through a partnership or an S corporation structure, and the IRS is now treating this as high risk, you need to assume this audit tests more than just paperwork. It tests valuation, disclosure, and most importantly, credibility and, scarily, intent. A single poorly handled response can transform a technical dispute into a life-altering criminal tax investigation. Be careful who you hire. At the tax law offices of Dave W. Clausing, we focus on high-risk civil and criminal federal tax controversies on a daily basis for the past 17 years. We immediately take control of communications so you don't wind up handing the government the intent narrative it needs to escalate your case criminally. If the IRS is asking about valuation, promotional materials, basis calculations, or disclosure filings, this is the moment to act. Call 1-800-681-1295 or visit clausing-associates.com to schedule a confidential reduced-rate initial consultation today. The earlier you control the record, the more likely your case is to stay civil. Thank you.